Welcome to the Canadian Slovenian Chamber of Commerce presents CSCC Business Insights 2023. I'm Sonia Rosenworth, the Chamber's Executive Director, and we're pleased that you've joined us as our members and associates present valuable business expertise and insights. Today, we're pleased to introduce Mr. Tim Cestnick, co-founder and CEO of Our Family Office Incorporated. He'll be presenting 2023 Canadian tax and estate strategies for businesses. First, I'll share our disclaimer. It will be posted on YouTube, so I won't be reading through it, but here it is. And some brief housekeeping points. Please stay muted so that we may hear all the presentation. There will be an opportunity to participate at the end of the presentation during our question and answer session. You're invited to post your questions and comments in the chat throughout the presentation, and we'll try to address them at the end. If we run out of time, I promise that we'll share them with Tim, and he'll be able to get back to you. You may also wish to email us at info@canslo.com. Note that we'll be recording today's event and posting on YouTube. The link will be shared on the canslo.com website, Facebook, LinkedIn, email to you, our members and associates. We prefer that you keep your cameras on, but you have the option to turn yours off. I'd like to take this opportunity to take a gallery view of our participants today. There will be a short survey at the conclusion of this presentation, and we ask that you share your comments for this and future CSCC events. Allow me now to introduce today's guest speaker. Mr. Tim Cestnick enjoys a reputation as one of Canada's most respected experts and public speakers in the area of tax and personal finance. Widely recognized for his in-depth knowledge, dynamic speaking style, common sense approach, and extensive national media exposure, Tim successfully combines business expertise and professional credentials to advise some of the most successful families in the country. Tim is co-founder and CEO of Our Family Office Incorporated, one of Canada's leading wealth advisory firms to affluent families. In 2021, Our Family Office Incorporated was named the best new multi-family office in North America by the International Family Wealth Awards. Tim's national speaking profile is confirmed by his position as a personal finance columnist for the Globe and Mail's Report on Business, Canada's national business newspaper. As a member of the Canadian Slovenian Chamber of Commerce, you actually get this emailed to you as soon as it's available. So just a little perk. As a prolific author, Tim has written several Canadian bestsellers, 101 Tax Secrets for Canadians, Winning the Tax Game, Winning the Estate Planning Game, and The Tax Freedom Zone. He's also authored Winning the Education Savings Game, co-authored Death and Taxes, and Your Family's Money, among other titles. He's also the past editor of Tax Tips for Canadians for Dummies. In addition to print media, Tim is a regular contributor and on-air personality on Canadian radio and television. He appears regularly on CTV, CBC Newsworld, BNN, and is the preferred financial consultant for all the best-known money programs in the country. Today, we're very pleased that he's joined us to share his tax and estate strategy tips. Welcome, Mr. Cestnick.
I think, as we talk about the federal budget, there wasn't a lot of things that most people would say, yeah, that really affects me. But there were some things, if you're a business owner or a senior individual in a business, that might be worth mentioning. So I'll talk a bit about that, and then we'll get into some other things as well. But before we jump into the actual content for the day, I just thought I'd start with a little lighthearted look at the top 10 list, a top 10 list where you would know you're paying too much tax. Okay, so think of this as the old David Letterman top 10 list. You know you're paying too much tax when number 10, T4 is relevant to you because it's your apartment number, or you know you're paying too much tax when number 9, RRSP is what you did in response to that wedding invitation last month. Number 8, you try to deduct Starbucks as a workspace. So you know you're paying too much tax when number 7, you've been offered a job with the CRA and you tell them that you'll take it if they pay you under the table. You know you're paying too much tax. Number 6, you know you're paying too much tax when you choose to use cloth diapers instead of disposable because HST won't apply. Or number 5, you pretend that you're a wounded veteran, your spouse is a volunteer firefighter, and your 8-year-old is a member of the clergy. That's when you know you're paying too much tax. You know you're paying too much tax when number 4, you turn yourself in for tax evasion in order to be paid the 30% reward for whistleblowers. Or number 3, you're expecting yet another Christmas card from CRA this year. That's not a good sign. You know you're paying too much tax when number 2, you've chosen to use the short form tax return, which has 2 lines. Line number 1, income. Line number 2, send it in. And the number 1 sign or reason or that you know you're paying too much tax. Number 1, identity theft is a problem, but the thief wanted nothing to do with your name or identity. There you go. Okay. I have no idea if you thought that was funny or not, but I laughed at it. So that's all that really matters. Now, where are we going today? What are we going to talk about? I want to share with you, as I mentioned, some things that came up in the 2023 federal budget. I also want to talk a little bit about something called employee ownership trusts, which was introduced in the budget, but may provide an opportunity for some business owners when it comes to succession planning for their businesses. We're going to talk about something called a capital gains strip, which is an idea we've been using for quite some time and is still available today. Remarkably, it was not shut down in the federal budget. Number 4, I want to talk about something I call the insured donation of shares. It involves, this is an idea that will allow you to eliminate tax on private company shares when you pass away using a gift to charity and life insurance. We'll talk a bit about how that works. Then I want to finish off by talking about something I call financial independence capital. A lot of business owners have as their biggest asset their business, and that's not surprising. But many fail to actually accumulate any kind of resources outside of their business, which I think is not a wise thing. But we'll talk a bit about that and a way to think about that. So that's where we're going to go today. Let's jump into the federal budget. Let's talk about what the budget had to say. The budget said a few things that were relevant to businesses. One of the things I'm not going to cover in a lot of detail, in fact, at all today, are a lot of the tax incentives for businesses to engage in green technology. Now, let me just say this, that the budget did introduce 3 or 4 different investment tax credits. So if you work for a company or own a company that does research and development, and you're looking at developing green technology, then there are some investment tax credits which can be available. And basically that's cash back in the pocket of your company for investing money in that kind of research. Now, the research is things like converting hydrogen to clean ammonia, things like that. So unless you're involved in that kind of a business, it's probably not that relevant. So I'm not going to spend a lot of time talking about that, but I do want to talk about some other things the budget introduced. For example, lower credit card fees. Federal government has negotiated with Visa and MasterCard to have fees on Visa transactions and MasterCard transactions lowered. The costs will be reduced by an average of about 27%. So that's, you can expect that to come down the pipe pretty soon. The budget also made some comments about intergenerational business transfers. I'm talking about transferring your business from one generation to the next. So from parents to children, that kind of thing. There were some changes 2 years ago that came about which made this possible to do or more tax effective to do. There were some loopholes that existed when they introduced the new rules, and the budget basically closes some of those loopholes. But when they closed them, they made the rules effective next January. What this means is that there's still some loopholes that the government knows about that we can take advantage of for 8 more months. So I'm going to talk about that today and give you an example of how that might work. Employee ownership trusts, which I'll talk about more in a minute, is a new approach to bringing employees into ownership of a business, and you might find it useful depending on your situation. Also, the budget talked about the student work placement program, which is something that you may be aware of, but the government's committed to funding it even more now. They're going to commit $197 million to this program over the next couple of years to continue creating work integrated learning opportunities for students. Now, specifically what this means for you, maybe as a business, is that businesses can receive up to $5,000 for every student that they hire, or up to $7,000 if that student is a first-year student in college or university, or if the student has is part of an unrepresented group. So women, for example, in the science, technology, engineering, and math programs, or persons with disabilities, or newcomers to Canada, Indigenous students, visible minorities. If a student is in that category, then you get $7,000 instead of $5,000 to help defray the cost of having them work for you. So if you want to hire students for a co-op program, bring them in for 4 months or 6 months or whatever it is, there could be some funding available there, which is helpful. Also, the government made some announcements about their procurement process. So really what they're trying to do, I don't know why they didn't do this earlier, is introduce a process that will give Canadian businesses a preference over international businesses when it comes to supplying goods and services to government departments or government agencies. So they want to give business to Canadian businesses, which just makes sense. So if you've got a kind of business where you're able to put in requests for a proposal or make proposals to the government to get contracts, you might find that process easier on a go-forward basis. Government also announced some measures related to tourism, the tourism sector. The government's going to spend $108 million over 3 years, starting today, to regional development agencies to support small businesses and nonprofit organizations in developing local projects and events. So, if you're in an industry that has to do with tourism or anything at all related to tourism, you may find funding available for projects or events that you want to run. Also, the government's committed $50 million to attract major international conventions, conferences, and events to Canada. So, if you're involved in that kind of thing, there may be money available to help fund some of these conferences or events or conventions. A couple of other things the budget announced, which may be relevant to you, may be relevant as an individual, not just as a business, are, for example, reducing junk fees, what they call junk fees. So in Canada, we do face a lot of hidden and unexpected and sometimes excessive fees. And the government is going to be introducing legislation to reduce some of these fees. And they gave some examples in the budget of things like internet overage charges or cell phone roaming fees, or in some cases, some baggage fees charged by some airlines, or event and concert fees, or excessive shipping or freight charges. So they didn't give much more detail other than to say that they're looking at these things and plan to bring in some legislation at some point soon to curtail some of the charges that we're facing. That's one way they're trying to combat inflation. And then lastly in the budget, there were some measures related to travel and immigration, which I think are worth mentioning. This applies to all of us as individuals. Things that they're doing, they've committed to reducing passport processing times. So if you need to renew your Canadian passport, that time can now is probably going to take you closer to 10 or 20 days as opposed to the months it might have taken earlier, especially during COVID. So they're reducing processing times. Likewise, for immigration applications, they're committing to reducing the wait times to process these applications, and they'll be adding some online tools to allow people who have applied for immigration to look at the status of where that application is. They're also looking to reduce airport screening wait times by committing more dollars to that process at different airports around the country. They're going to be introducing also new laws to increase airline obligations to compensate travelers for delays and cancellations, because they haven't been very happy with that. And last thing, the government will be increasing something called the air traveler security charge which is a fee that you might have noticed in the past that gets added to every airline ticket. If you're departing an airport from an airport in Canada, those fees are going up a little bit. It's not a huge dollar number, but you could probably expect somewhere between $15 and $30 more per flight that departs from Canada starting next year, May of next year, not this year. Just to make you aware of what's coming down the pipe there. So as far as federal budget goes, that's pretty much it. That, you know, as far as what impacted business owners. I do want to touch again on this employee ownership trust concept, because I mentioned it and it was in the budget. It's a new thing. And let me share with you some of the basics, and then we'll get into some more details and then some benefits of what these plans. So an employee ownership trust is really a legal trust that is set up by a lawyer. A law firm would have to set up a trust for you, but it's an employee ownership trust that makes it possible for a company to become owned by its employees. Now, these trusts will be set up by, for example, an existing owner that maybe as part of a succession plan may sell part of their shares or all of their shares to this trust. So it really can be used as an exit strategy, or if somebody's just starting up a new business and they want it to be partly or fully employee owned, you might set up one of these employee ownership trusts as well to help accomplish that. So the owner would, for example, as I mentioned, maybe sell shares to the new employee ownership trust, and you'd make that sale at fair market value. So as a business owner, you're exiting your position in your company or giving up control. We'll talk about that in a second. But you are going to be paid fair market value. Now, an employee ownership trust has to have two purposes. One is to hold the shares of a qualifying business, that could be your business. And secondly, to make distributions to employees who are beneficiaries of this trust. And those distributions need to be based on a formula. The formula can be different for every company, but generally the formula should consider the length of service of an employee, their current compensation, the hours that they work. Those are the kind of factors that come into play when deciding how much employees should receive in terms of distributions from this employee ownership trust. Now, more details about this. So employees don't actually own the shares directly. It's actually the employee ownership trust that owns the shares. So these employees don't actually participate in the future growth in the value of the business. They're not going to own shares that go up in value that one day they can sell. Rather, what they are participating in is a share of the profits of the business. So a share of the profits or earnings can be paid from the company up to the employee ownership trust. And then the employee ownership trust would distribute those earnings to employees as dividends. Now, employees don't actually put up any cash to buy shares here. It's the trust that will pay the owner over time. And where's the trust going to get that cash? It could borrow the money, but it can also receive cash from the business itself, either in the form of loans or dividends to ultimately pay out the owner. And here's an important element of this. The employee ownership trust has to acquire a controlling interest in the company. So you can't sell 40% of your company to an employee ownership trust. It's got to be more than 50%. So that's important. And for the business to qualify, it has to be a Canadian controlled private corporation where, you know, about 90% or more of the assets of the company are used in an active business being carried on primarily in Canada. So if that's the case, then the company could qualify for this. Now, also, the shares that are in the company that are owned by this employee trust, those shares are controlled by the trustees of the trust. Now, who are the trustees? Well, these will be employees or individuals who are Canadian residents and are elected by the employees. So the employees can actually choose who the trustees will be, and those people must stand for election every 5 years. So the trustees could change every 5 years. Now, anybody previously holding a significant economic interest in the company, so if you were the primary shareholder or you controlled the company in the past, you're not allowed to account for more than 40% of the trustees of that employee ownership trust. In other words, you can't maintain control by having majority of the votes as a trustee. So you truly are giving up control here when you do this. You can't be more than 40% of the trustees. You can't hold more than 40% of the votes of the board of directors of any company controlled by the employee ownership trust, or by any, you can't control more than 40% of the board of any corporation that's serving as a trustee. So basically what the government is saying is you really need to give up control here. Now, in some cases, owners may say, okay, I'm ready and able to give up control because my employees are doing a good job. They can manage the business. All employees of the business are eligible to participate as beneficiaries of this employee ownership trust. You can't exclude certain employees and include other ones. Everyone's included except those who either currently or in the past held a significant interest in the company. So like yourself, if you're the business owner, you can't participate in this employee ownership trust, you're excluded. And also those who haven't worked at the company long enough. Generally, you can stretch out that period as long as 12 months. But once an employee's been there for 12 months, they would then become a beneficiary of this trust and effectively, become an indirect owner in the business then. And the shares of the company can never be distributed to the employees by that trust. All right, it's only a share of the profits that can be distributed out to the employees. Now, what are the benefits of this kind of a trust arrangement? Why would you even think about this? First of all, there's some tax benefits, and then there are some non-tax benefits. So we'll talk about the tax benefits first. So from a tax point of view, the rules will allow you to spread your capital gain on the sale of your business to the trust over a period as long as 10 years. So normally when you sell your business, you're going to pay tax all at once in the year you sell, or you might spread it out maybe over a period as long as 5 years if you take payment over 5 years. That's under the current rules. But under these new rules, you can now spread out that capital gain over a period as long as 10 years. Also, this trust, employee ownership trust, could borrow money from the company. That borrowed money can be used by the trust to pay you, make payment to you for your shares. And if you do this, the usual shareholder loan rules will not apply. And for those of you who have experienced these rules, they're not easy to get around, and they're not very positive rules. They're, if you borrow money from your company, typically you're taxed on that amount as regular income if you don't pay it back to your company within about a year. So, this new employee ownership trust gets around those rules, and you bypass those rules, avoid them altogether if the trust borrows the money. Also, most trusts in Canada are subject to what we call a 21-year rule, where every 21 years, the trust is deemed to have sold its assets, and that can trigger a tax liability at the end of 21 years. Well, these kind of trusts, these employee ownership trusts, will not be subject to the 21-year rule. Okay, so those are some of the tax benefits of them. And then, other than taxes, why else would you even think about doing this? Well, if you're an owner of a business and you want to try to preserve the legacy that you've created, you want to transition the business to new ownership, but you want to preserve the culture and the values that you've created in this business, because that's very important to a lot of business owners. You want to make sure the employees are looked after. You want to make sure that, a new owner that you sell to doesn't come along and dramatically change the culture and fire a lot of your good people. This kind of employee ownership trust can really work well in that kind of a situation, because it really allows you to keep the culture, keep employees. Also, the employee ownership trust provides a more certain kind of exit strategy than some other approaches. If you choose to sell to a third party, which could still make good sense, though we've seen situations where those negotiations kind of fall apart after they get intense, or buyers retrade the deal. They say they want to buy your business, they agree to a price, and then they start doing due diligence. Then they come back and say, oh, well, we saw this, we noticed that, we noticed this. Now we're reducing our offer to something much lower. You avoid all those kind of problems, the problems associated with selling or even finding a third-party buyer. That it can be a challenge. So you avoid those kind of problems with an employee ownership trust. Also, there's evidence that employee-owned businesses are actually more resilient. Many of them have came through COVID much better, and just in general are more resilient than businesses that are not owned by employees. And there's much lower employee turnover. People don't leave as quickly when they're part owners in a business or have indirect beneficial ownership in a business. And also, when you've got this kind of an arrangement where employee ownership is there, it actually differentiates your business from a lot of other ones. And so when it comes to hiring people, it can be a real selling feature to a new employee. So anyway, those are some of the benefits of employee ownership trusts. So hopefully that hasn't left your head spinning too much. And more importantly, I hope you're still all wide awake. Someone told me one time that if you took all the people who've ever fallen asleep in a financial seminar like this, and you laid them end to end, they'd be a lot more comfortable that way, actually. But we're not going to stretch you out on the floor. We want to keep you awake, though. So I want to talk now about something we call the capital gains strip concept. This was an idea I was convinced would actually disappear in the federal budget. It did not. Well, not really. In one manner, it did, but the government has given us a time window to still take advantage of the idea. So I want to talk about this. The capital gains idea, what it does is it allows a business owner to extract funds or remove funds from their corporation at capital gains tax rates rather than at salary or dividend rates. And so in Ontario, for example, you're looking at closer to 26% rather than pulling out salary, which could be taxed at 53%, or even dividends, which could be taxed at 39% or 47%. So this can be quite an attractive thing. Now, this type of planning is often referred to as a capital gains strip. And the window for this planning is still open, but it could be closed in the near future. I would not be surprised if they shut it down in the next year. I was surprised they didn't shut it down in the budget recently. But I want to talk about a couple of, one way of using the capital gains strip in particular. There's more than one way to do it, and I won't get into the many ways of doing it, but I do want to talk about something called Bill C-208 planning, because Bill C-208, which I'll talk about in a second, allows us to use a capital gains strip to pull money out of a corporation in a certain scenario. So I want to sort of walk through that scenario now. So let's talk about Bill C-208 and what is still possible. So let's back up a little bit and talk a bit about why Bill C-208 existed and what it said. So basically in the past, I'm talking, 3, 4, 5 years ago and longer, it was actually more tax effective to sell a business to an unrelated third party than to sell it to your own kids. And that didn't make any sense, because what the tax law did, it would actually take your sale proceeds, and rather than letting you pay tax on a capital gain, it would actually cause the income to be taxed as dividends. And that was worse. So that's when you sold it to a child. So the government, a private member bill was introduced in 2021, a little bit prior to that, actually. And it became Bill C-208, and it was aimed to fix this problem so that business owners could sell to their own kids and not be at a disadvantage. So the rules, Bill C-208 did receive royal assent and became law in June of 2021. But when they introduced the rules, there were some loopholes that existed. And these loopholes basically allowed business owners to pull money out or extract cash out of the company at capital gains rates without really making a true transfer to the next generation, without really transferring your business to your kids. And that was kind of an oversight. And the government, came up with the new rules, and they said, oops, I guess we kind of overlooked that, and we're going to change the rules to fix the problem. So Budget 2023, which was tabled just a couple of weeks ago, actually did fix the problem, but the fix doesn't become effective till January 1st next year. They know that this loophole still exists, and they're okay with it until January of next year. So there's still an opportunity until that time to still take advantage of this idea. So let me share with you exactly how that works. I think the best way to look at this is take a simple example. Let's take a person, let's call him William. And William is a business owner, and he has a company. And let's say the company's got cash on the balance sheet. Let's say his company's worth $10 million, and that's a big number, but let's just say his company's worth 10 million. And let's say he'd like to pull $1 million of cash out of the company for his own personal use. He also wants to introduce his son, let's call him Trevor, into the business as a part owner. Now, in this case, let's assume Trevor has worked hard in the business and he's ready to own part of the business. Now, William doesn't want to give up control. He doesn't want to give the whole business to his son, but he wants to give his son some ownership. Trevor one day will eventually own and operate the business on his own, but today his dad just wants to bring him in a little bit. And in the process, pull some money out of the company at a very tax efficient rate. So William can actually use the rules that were introduced by Bill C-28 to extract a little over $1 million of cash at capital gains rates. Again, this opportunity will be shut down next January, but it's still good for today. And he also wants to provide Trevor, his son, with 15% ownership in the company today. Let's just say 15% is the number. So let's look at something here for a second. Supposing William wanted $1 million of cash in his pocket, and he had different ways of pulling that money out of the company. Let's say he pulled it out as salary, or that's the first column on the left-hand side here. You'll see salary at the top. The other way he could pull money out is by way of a dividend. Let's call this an ineligible dividend, or he could pull it out at capital gains rates, which is the column on the right-hand side. Well, if William wants to pull $1 million of cash out of his company after all taxes, so he's got $1 million in his pocket, he'd have to pull $2.1 million out of the company as a salary. If he chooses the salary option, he'd pay $1.1 million in taxes on that, and then he'd be left with $1 million of cash. That's a pretty high tax cost, okay? Now, yes, the company would get a tax deduction for the salary it pays him, and there might be EHT, employer health tax payable, that would be deducted. So at the end of the day, the total tax cost to William would be $527,000. You can see that in the bottom red box at the bottom there, the total tax cost. If he pulls the money out as a dividend instead, he only needs to use $1.9 million worth of cash. He'd pay $913,000 of tax on that dividend, and then he'd be left with $1 million in his pocket. Go to the very right-hand side. Let's look at the top at the right. It's a capital gain now. We want to structure this as a capital gain. He would only need to pull out $1.3 million of cash. He'd pay about $360,000 of tax on that and be left with the $1 million of cash in his pocket. So capital gains are obviously the most tax-effective way to do this. So how can we take advantage of Bill C-28 still today to do this? So let's get back to our story of William and his son. So in this case, William owns his operating business. Let's call it $10 million of value. He owns all the shares. But Trevor, his son, who works in the business, is going to set up a company. There's Trevor. You can see a picture of him. He's working really hard. He's cleaning the floors in the business. So William likes Trevor in the business. Trevor is going to set up a company, call it Trevor Co. And he sets it up for $10. That's not going to cost much money to set up Trevor Co. He puts $10 of capital in the company, or next to nothing, actually. Step number 2 is William's going to sell 15% of his common shares because he wants Trevor to come into the business and own 15% of the operating business. He's going to sell Trevor Co. 15% of his common shares. And Trevor Co., how's Trevor Co. going to pay him for that? Because that's $1.5 million of value there. Well, he's not going to pay him cash. He's just going to pay him by way of a promissory note. So really, we have Trevor Co. now owns 15% of the shares of OpCo, and Trevor Co. owes $1.5 million to William as a promissory note. And William still owns 85% of the shares, and William will pay tax on that transaction, but it's going to be taxed as a capital gain. Okay, so how much tax will William pay on that capital gain? Well, William can actually use his lifetime capital gains exemption, which is available to everyone who owns qualifying shares in a private company. And that's going to shelter $971,000 of this gain from tax. And so the only tax bill he's going to pay is going to be $141,000 of taxes, which, that William's in the highest tax bracket in Ontario. So we'll assume he pays $141,000 of tax. That's not a lot of tax, actually, on $1.5 million of money coming out of the company. Now, we're not quite done here. The operating company is going to take $1.5 million of cash. It's going to pay a dividend up to Trevor's company. That is going to be a tax-free intercorporate dividend. Now, I'm making some assumptions here, but just a general rule, that would normally be a tax-free intercorporate dividend. So that tax-free cash goes from the operating company up to Trevor Co. Now that $1 million of cash can now be used to pay off the note that's owing to William. Okay. Now William has to pay that tax. He's going to take the $1.5 million. He's going to pay the tax that he owes to the government on that capital gain earlier. So he's still left with $1.36 million of cash in his pocket. So you can sort of see the end picture here. Trevor owns 15% of the operating company through his company, Trevor Co. William owns 85% of the shares still. And William has $1.36 million of cash. And that was really paid to him as $1.5 million, on which he paid $141,000 of tax. Not much tax, only a 9.4% tax rate on that, on the shares that he sold to Trevor Co. Pretty low. Now, what's happening next January? So beginning next January, the following is going to change that will make this idea not possible anymore. William, in order for the rules to apply, will have to give up control of his operating company. See, right now he just sold 15% to his son. But starting next January, will have to be more than 50% that he sells. So he must truly give up control. Trevor must control both his Trevor Co. and he must control the operating company, both. And Trevor will also have to be actively involved in the business day to day, which he is. But in cases where maybe the kids are not involved in the business at all, that's okay today. Starting next January, it won't be okay. So there's a window of opportunity here between now and next January to actually bring children into the business as owners, and at the same time extract some money from the company on a tax-free, on a very tax-efficient basis as a capital gain. And that capital gain could be eligible for the lifetime capital gains exemption as well. So there's some planning to be done now, a window, okay? Okay, that's all I want to say about the capital gains strip and Bill C-28 planning. I'm going to share with you another idea now that's more of an estate planning idea. But here's a common issue, right? Business owners own shares in their private companies. And over the course of time, those businesses, if they're successful, grow in value. And those shares that are owned by the owner will grow in value. And what happens is at the time of death, you're going to face tax on those shares. Or if you leave them to a spouse, then maybe on your spouse's death, there will be some tax to pay on those shares. So I want to share with you now an idea that will allow you to fully or partially eliminate the tax on private company shares when either you or your spouse pass away. Now, this idea I'm going to share with you is going to, as I said, eliminate tax on the private company shares. It's going to also result in a very meaningful gift to charity. And on top of that, it's going to leave much more value to your kids, to your heirs at the same time. Now, also, we want to keep in mind when we set up this idea that we want to try to keep things as simple as we can and try to keep the costs of implementing this idea as low as we can. But no, there's going to be a little bit more complexity. Anytime you get into, clever tax planning, there's going to be some measure of complexity that you have to kind of live with. But let me tell you how this idea works. So this idea works this way. Upon your death, if you're the business owner, a portion of your shares, not all of them, but some of your shares in your private company will be donated. Now, normally we set this up that these shares are donated to a private foundation. Quite often it's a private foundation that your family will set up for itself. Could be a public foundation, like a community foundation or another public foundation. There's lots of options out there. And what that will do is it will give you a donation tax credit in your year of death for the value you've donated to the charity. I'm going to give you an example in a second here, but we'll walk through some numbers. But just understand that you're giving shares worth something to charity and you're going to get a donation tax credit. So here's your holding company, let's say, and you're going to donate shares to a registered charity or to a foundation when you pass away. Not all of your shares. Normally, to make this work, you would donate somewhere between 35% and 40% of your shares normally to make that work. If you want to eliminate all the tax on your private company shares. If you don't care to eliminate all the tax, maybe you just want to eliminate half the tax, then you might only donate 20% or 25% of your shares. Okay. Step number 2, though, is after you're gone, you've donated by way of your will. Your will has to be revised, by the way. Your will donates some of these shares to charity or to a foundation. But step number 2 is this. Your company will have purchased life insurance. on your life, or more likely on the joint lives of you and your spouse. It's cheaper to buy life insurance that way than to buy all the insurance just on one life. So let's say you and your spouse buy a policy. It would be owned by your holding company and paid for by your corporation. Okay. So when you die, not only do you donate some of your shares to charity, but the life insurance that's owned by the company will now pay out, and it will pay out to the company. So now the company will have this cash. Now, it's a perfect time for this company to receive cash. Why is that? Well, because the charity that you donated your shares to, the charity doesn't really want your private company shares. Your foundation or a foundation doesn't want your private company shares. It can't do anything with those shares. So what's going to happen is we're going to use some of the cash from the life insurance policy when it gets paid into your company to buy back the shares that were owned by the charity or the foundation. So in other words, you're redeeming the shares that were owned by the foundation. So what happens is the cash gets transferred to the charity. The charity ends up with cash, which the charity is very happy with. Your foundation will be able to do much more with cash than it can with your private company shares. The rest of your shares continue to be owned by your estate, by the way, or your kids. Okay. So the life insurance has been used in part to buy back the shares from the charity. Now, step number 3 is this. The shares that are now owned by your kids or by your estate are going to be redeemed. And this should happen in the first taxation year following your passing away, the first 12 months generally of passing away. Now, when these shares that are owned by the estate at the time of your death are redeemed, 2 things happen. Number 1, that's normally taxable as a dividend. If you redeem shares in your company, it's normally taxable to you as a dividend. The good news is, in this case, even though it's taxed as a dividend to your estate, it's a tax-free dividend, totally tax-free. Now, why is that? Because your company is going to have something called a capital dividend account. Back when the life insurance went into the company, it bumped up something called the capital dividend account of the company. That now allows your heirs, your estate, to redeem the shares, redeem some of those shares, and to pull money out of your company on a tax-free basis. Okay. Now, in the process of redeeming these shares, something else happens. I won't get into math behind it, but a capital loss is created in your estate. And that capital loss can offset other tax that would otherwise be owing at the time of your death. So just to summarize here, to go back and sum up what we've talked about, there are 3 benefits to this idea, 3 tax benefits. Number 1, a donation tax credit, which will reduce or eliminate the tax owing on your private company shares. Second benefit is because you're using life insurance, it bumps up the capital dividend account of the company when the insurance gets paid out. And that creates a tax-free pipeline out of your company to your family, okay, through a redemption of shares. But it's a tax-free pipeline. And then the last benefit is this capital loss I talked about, which arises in your estate when shares are redeemed, and that can offset other capital gains or other income in your year of death. So now just to step back and say, okay, give me an example, Tim, show me what the numbers look like here. So let me give you an example of an individual that owns a company. Let's just say the company is worth $2 million, okay? Let's say it's a holding company that's worth $2 million. And this individual likes the idea that we've just presented and says, okay, I'm going to buy some life insurance in my company. And let's say they buy $1 million worth of life insurance. Now, where do we get the $1 million number? Well, it's about half of the value of the company. So the company's worth $2 million. So this individual buys $1 million of insurance. Does it have to be 50% of the value of the company? No, it doesn't. But you generally want to buy enough insurance so that you can at least pay out those shares that the charity is going to inherit, okay? That the charity is going to receive, the foundation is going to receive. So in this case, it's $2 million worth of value. The individuals purchased $1 million of life insurance on a joint last to die basis. So it's in the lives of the owner and his or her spouse. Now, when the individual dies, they're going to donate 40% of the shares to a foundation. So let's look at what happens when this takes place. So in the first scenario on the left-hand side here, it's the do nothing scenario. That's assuming that nothing is done. This idea is not implemented at all. So in that case, that $2 million corporation becomes taxable at the time of death of the second spouse. And there's going to be tax owing to CRA of $535,000. Okay, that's the capital gains tax rate in Ontario this year in 2023. So the $2 million of value that's sitting there in the company, the family inherits about $1.4 million of value. CRA gets a little over $500,000 of value. Now you might say, okay, Tim, I like the idea of this donation idea, but I don't like the insurance part of it. So let's see what it would look like if you didn't buy insurance, but you just decided to donate some of your private company shares to charity. So if you made the donation, but you didn't buy insurance, let's say you donated 40% of your shares. Well, your company's worth $2 million. So if you donate 40%, that's $800,000 of value you're donating to charity. So by doing that, you do get a donation tax credit. You're going to eliminate a lot of the tax owing to CRA. The tax you were owing to CRA drops from $535,000 just to $130,000 because of the donation you've made. Now, your kids will inherit the balance, which is just over $1 million. So the disadvantage of this idea is that your kids are a little bit worse off. The charity does get $800,000, but the problem is the charity doesn't get cash; it gets private company shares. So this scenario number 2 is not ideal. So let's move over to scenario number 3, where now we're using life insurance. We've bought $1 million of insurance. So upon death, the insurance gets paid into the company. And then we use $800,000 of that insurance, okay, to buy back the shares from the foundation. So the foundation ends up with cash, $800,000 of cash, funded by the life insurance. The excess life insurance over and above $800,000 goes in, it stays in the company, and effectively the family benefits from that. Now, in this case, I've assumed that the value of the policy grows a bit over time because the cash value will grow. So there's a bit of, a bit more than $200,000 of insurance left to go to the family. But you can see what happens in this case. In scenario number 3, your heirs end up inheriting about $2.5 million. And that's compared to, the do nothing scenario, which was only 1.5. Plus on top of that, the charity gets $800,000 of cash. All of this is funded by CRA, by tax savings that you've created through the process. And the tax savings are down below at the bottom of the page. You can see the taxes saved from the donation of shares is $400,000. The taxes saved because of this tax-free pipeline we've created using the capital dividend account is $477,000. And the tax savings from the capital loss we've created in your estate is $133,000 for total tax savings of $1 million. So CRA is the only one that loses in this case. Another way to summarize this, the net benefit of this strategy is that there's $1.8 million of value created here. Now, who gets how do you get that value? You can see it on the left-hand side. It's partly tax savings, it's partly cash in the foundation, it's partly insurance to the family. You do have to subtract the cost of the insurance premiums. That's going to come off the top. But in this example, it's $1.8 million of value that is generated. Who gets the $1.8 million of value? Well, $1 million goes to the family and $800,000 goes to the foundation. So in other words, another way to think about it is for every dollar of insurance that you pay for, there's about $4.38 of benefit that goes to the family and about $2.67 of benefit that goes to the foundation for total benefits of just over $7 per dollar of insurance you pay for. So anyway, that's the concept. It's quite possible to have the numbers crunched for your particular situation if you're interested in this idea. I'd be more than glad to help you with that, or another accountant who's a tax specialist could help with that. Okay. Hopefully your head's not spinning too much. This one's, I promise you, a little easier to grasp, and this will finish off our conversation, and then we'll take some questions. So in this case, I want to talk about financial independence capital. Okay. Financial independence capital, what is this? This is the amount of money that you need to look after you and your spouse, if you have a spouse, for the rest of your lives. If you had no other assets, no business, nothing else, okay? What would that pool of money look like? That's what we call your financial independence capital. And the amount is different for everybody, but the amount that is needed is generally calculated based on how much you spend every year on an after-tax basis, and based on assumptions about inflation. Because if you're spending a certain amount now, well, inflation is real and it's going to be more next year that you have to spend. So it also is based on assumptions about inflation and assumptions about rates of return. Now, how much money can you earn on that pot of money that represents your financial independence capital? But most business owners neglect to accumulate money outside of their businesses. And there should be a balance between building safe capital outside of your business and reinvesting money in your business. Okay, I'm going to suggest that. Now, why would you ever, I get that question all the time from business owners, why would I ever take money out of my business when I can grow my business and put more money back in? Well, I'm not just suggesting you don't do that. You do want to grow your business, but I think there's a balance. Because having no financial independence capital, no capital outside of your business can be a problem in a number of situations. So for example, there may be factors outside of your control that affect the performance of your business. Maybe it's the industry you're in that's going to suffer in the future because of technology changes or whatever it is. Or maybe competition comes along or government regulation comes along or whatever it is, things you can't control that may affect your business. Having money outside of your business is going to help to preserve your well-being financially. Also, a lot of businesses eventually transition to the next generation or maybe get transitioned over to employees. But if you're an owner and you still use the business as your quote unquote pension plan, there's going to be competing objectives for cash flow of the business. So I've seen this happen before where parents transfer business to the kids. Kids are taking over the business. They're doing a great job. They're running the business. But what do the kids want to do? The kids want to plow money back into the business and continue growing it, where mom and dad want to pull money out of the business because they need to, because the business is their pension plan. And you've got competing interests now. And that can be a real problem in many situations. We've seen that happen. Or maybe the business can't be sold. If your plan is to sell the business down the road, maybe it can't be sold for as much as you think, or can't be sold at all. So especially if you're critical in the business, maybe you can't sell it. So that can become a challenge. So having financial independence capital outside the business may be important. It's also a problem when you sell to a third party and agree to stay on for a period of time, which is pretty common, but maybe you end up leaving earlier than you thought you would. And this is so common where business owners sell their businesses. Like they say, I'll stay on for 3 years. But after a year, they just say, I got to get out of here. I'm not happy with what's happening with the business. I don't like what the new owners are doing to the business that I built. And you leave. And often you walk away with less money than you thought because you don't earn the full amount of money that, you're not able to collect the full earnout, or you don't get the ultimate price you expected to receive. So in that case, you may end up with less than you thought you were going to be. Also, there may be a mismatch between the time that you would like to transition out of the business or retire or sell the business and the actual timing of the sale or that transition to the next generation or employees or a sale outside to third parties. There may be a mismatch in that timing and the ability to look after yourself financially without necessarily having to rely on the business or be involved as much day to day. Having that financial independence capital will become important. Or maybe you want to invest in something else too. Maybe you want to invest in other ventures or real estate or other assets, but you can't because all your financial resources are in your current business. Or maybe you need to provide funding for other priorities, a child's education, purchase of a cottage, paying for emergencies, but all your cash is in the business. And now you face shareholder loan rules in an attempt to access that cash at the last minute. That can be a problem. Or maybe you want to utilize the lifetime capital gains exemption, which we talked about earlier, but you left all your cash in the company and now the company may not qualify for the tax incentive. Or maybe you want to accumulate cash inside, you've accumulated cash inside your business, and now you might lose access to the small business deduction because your company's earning too much passive income. These are all problems. And, a couple last things here. Maybe you want to leave all your earnings inside the company and the company is sued for some reason. Well, those earnings can be subject to the attack of creditors now. Or maybe you want to borrow money personally, but using corporate cash or assets as collateral, creates a tax problem since you're using corporate assets for a personal benefit. And there could be more reasons. Like, this is just a few reasons why it's important for business owners over time to build up some assets outside their business. Let me just, as a final graphic or picture, show you this one. This is a picture. We calculate this for many of our clients. Let's suppose you have an individual, call them John and Jane Doe. It's a couple, they own a business. And let's say they've got $3 million of investment assets outside the business. They've done a good job at accumulating some capital outside the business. Well, how much would a family like this or a couple like this need to look after themselves for the rest of their lives? Well, if they spend $200,000 a year after taxes, which is a fairly big number, but if they spend $200,000 a year after taxes and they're age 60 today, then they're going to need, you can see this gray shaded area on the right-hand side here. They're going to need financial independence capital of about 5.9 million. That's the pool of capital they're going to need. Well, do they have that much today? Well, they haven't pulled that much out of their company over the last few years. In this case, they have pulled out 3 million, which is a good start. And after taxes, that 3 million would be, let's call it 2.7 million. We've made some assumptions about capital gains and things here, but they're still not at the level they need to be at. So where are they going to get the balance of their income? Well, maybe the balance of their income is going to have to come from the business. Okay, they haven't built up enough outside the business to look after this $5 million need. So they've only got 2.7, or maybe half of that looked after through other investments they pulled out of the business. So the balance is going to have to come through dividends or salaries from the business, which on the right-hand side, you can see is represented as this projected income number. They're going to need to pull out the equivalent of 4.2 million over time. Well, they're planning to pull out 4.2 million over the course of the next several years. So overall, their financial independence is looked after. But you can see from this picture on the right-hand side, that gray shaded area represents the amount they need, 5.9 million. That's going to be met through a combination of liquid assets they've already pulled out of the business, which is only 2.7 million after tax, and projected income they're going to pull out of the business over the course of years. So their need is met. They have a little bit of an excess, in fact. But this does assume that they're going to be able to continue pulling money out of the business, and that the business won't be subject to, other financial problems or whatever else. So what we'd like to see over time is that financial independence number fully satisfied by the liquid assets on the right-hand side that don't depend on the business at all. That's really where you want to get to in a situation like this. Okay, I'm going to stop right there. That's a lot of information, and I know there may be some questions. I'm glad to stop right here and answer any questions you might have, or answer any thoughts you might have.
Thank you, Tim. Maybe stop the share and we can
here,
see the gallery. Does anybody, if you want to just put up your hand if you have a question, otherwise I have a couple of questions. Yes, Joe, please unmute.
Actually, there was a comment made in the comment section. I'll address it because it's a good one. This someone did this capital gains strip that we talked about last year because they were concerned it would be gone, and we are concerned that it will be gone in the future. And there were a lot of accounting and legal bills associated with the strategy, but you were happy with the outcome. So thanks for that comment. There are some legal costs associated with it, no question. There are some accounting fees. You wouldn't do this if you're going to pull $25,000 out of your company, because the legal fees and accounting fees would eat up a lot of that. But if you're able to pull out more, probably in the hundreds of thousands instead, it could be 100,000 or could be a lot more than that, then this idea starts to make good sense. But thanks for that comment.
That was John Oldshire.
Yeah.
Joe, you have a question?
Yeah. The employee ownership trust. Tim, what happens when the business is sold at some point down the road?
Yeah, that's a great question. So what would happen is that there would be a capital gains tax to pay. The employee trust would have a tax bill to pay. There would likely be some proceeds left over after that, and those proceeds would then be distributed out to the employees in some proportion. It would be distributed across everybody who's a participant in the employee ownership trust. It doesn't have to be equal. Everyone would be different depending on how long they've worked there, what their compensation is like, how many hours they work, that kind of thing. But eventually the proceeds would be distributed out to people. So in that sense, they may actually benefit from growth in the shares of the company, but only if the business is ultimately sold.
Okay, and that would be based on the employees who are still in place at the time of sale.
Exactly. You'd have to be an employee at the time the business was sold.
And a member of the trust.
Yeah, a member of the trust, which means you've worked there for at least 12 months probably.
Yeah.
And
Okay, thank you.
yeah, you're welcome.
Thank you, Joe. Any other questions from the gallery? Irene?
I was just going to say further to that question, Tim, maybe just clarify. The individuals, though, they would have no capital gain exemptions, or would they?
No, I expect they probably would, as long as the shares of the company still qualify as qualified small business
Qualified.
corporation shares.
So
then
they go over
should
in the
be.
trust and then funnel down to all the individual employees,
Yes.
so you could sprinkle.
Yeah, so the tax paid by the employees may be very little and maybe nothing, depending on how much the company is sold for, because they should have their exemptions available. There's also a condition, of course, that people own their shares for typically, well, the shares have to qualify, normally a 2-year period. But yeah, I think that's a definite benefit to being an employee of a trust like this.
Actually, just a question, but didn't you say that the trust shares were non-growth shares? So that they wouldn't.
No, the trust shares are growth shares. It's just that an individual, let's say an employee is a beneficiary of the trust, and then they decide to leave the business. So they say, like, I want to quit or I want to retire. They can't say, cash me out, give me my shares. That's not possible. Or they can't receive the shares out of the trust. The only thing that can be distributed out of the trust is cash. So, but cash can be distributed out of the trust, not shares. So if the company was sold, you could distribute money out to somebody. But if somebody retires and the company has not been sold, they wouldn't be able to receive anything in that case. Good
I
question.
have a question. I'm not sure. This is not my question. What are the financial thresholds at which different types of business entities make most sense tax-wise? This might be a very big question.
Yeah,
Annual revenue income, certain value of assets, number of employees, etc.
Yeah, good question. My thinking on this is that I mean, a corporation is obviously the most obvious kind of business structure. Aside from corporations, you've got proprietorships, you've got partnerships, but generally the corporation is the most common and makes the most sense for most businesses for a few reasons. Number one, corporations offer limited liability. If somebody gets sued, you're kind of protected personally if it's the company that's carrying on the business, that kind of thing. So, but when should you set up a corporation? Maybe you're working as a proprietor today, which means a proprietor is just you hanging up your shingle saying, I'm in business, right? And there's no separation between you and the business. You are the business. But with a corporation, it's a separate legal entity. Normally, I would suggest that if you can take advantage of the tax benefits of a company, and what I mean by that is there is a tax deferral available. If you earn active business income in a company, it's going to pay lower rates of tax on that than you will personally, as a general rule. And so because of that, if you're earning enough income where you can leave some of the income in the company and not pull it out and spend it yourself, then you're in a situation where maybe incorporation makes sense. If you're going to earn money though and pull every dime out of the company to pay yourself as a salary, you're not benefiting from the tax deferral that's available in the company. So for example, if I earn $100 in the company, I could be left with 87 cents, almost 87 cents after taxes to reinvest in my business or do something with, do something with that money. Whereas if I earn the money personally, I'd be lucky to be left with 74 cents. I'm probably going to be left with something more like 60 cents. So earning money in a company does make sense, but if you're not leaving any money in the company, the tax kind of catches up to you and you're not benefiting from it. So normally I'd suggest you need to have probably at least $30,000 of net income in the company every year that you're leaving in there to face tax at corporate rates that you're not pulling out. And then it can make sense to incorporate.
Thank you, Stan.
Hi, Tim. Good presentation. Just got a quick question on the employee ownership trust. If a business owner ends up doing this, are they privy to the lifetime capital gains exemption?
Yeah, sure. The owner can use the lifetime capital gains exemption up on the sale to the trust, which is great. And then if the shares were ever sold by the trust, the exemption would again be available to beneficiaries of the trust. So yeah, it is available.
So if a business owner does that and there's 100 employees, for example, and let's say one leaves at any point in time, quits, leaves, do they forfeit their
Yes,
share?
they forfeit their shares. They don't get shares out of the trust. Shares can never be distributed out to them. You can't say, okay, you're going to leave. Let me just give you some shares out of this trust. And when you leave, we'll buy you out. No, that can't happen. So if you leave the employment of the company, you're not getting anything on your departure, unless they pay you a severance or a retiring allowance or something, but you're not going to get shares of the company.
So if, for example, there's 2 employees and you do this, and one employee leaves, does the remaining employee now go from 50% ownership to 100% ownership?
Indirectly, yes. Indirectly. Yep. That's right. They still can't take the shares out of the trust, but they would get 100% of the dividends if there are dividends paid on the company shares now. Normally, because those shares would normally get shared among whatever employees are there.
Okay.
Yeah. The idea may not be best for everybody. It's just another kind of tool in the toolbox when it comes to succession planning and can be looked at. Yeah.
Okay.
Thank you, Stan. I have a question that's going to have some of your eyes rolling. I appreciate this. What would be the best strategy for any cryptocurrency held by an estate or a business? Is there a way to offset any taxes here? Okay, I'm not even going to look at the screen now.
Yeah. Well, there's two issues here. One is, should you invest in crypto? And if you should, or if you are, how much is the appropriate amount as a percentage of your total portfolio? That's all that separate issue. Then there's the tax issues, which, and the answer to the question really is it's not any different than other income you might earn. So if you're making profit on cryptocurrencies or any profit on anything for that matter, you always have to ask the question, how do I minimize the tax? And the first answer would be, well, are there deductions you can claim? Maybe you've subscribed to research, you've got research subscriptions you're paying for, or there are transaction costs, or you probably don't have an employee doing the trading for you, so you're probably not paying wages, but you try to think of all the expenses you possibly can related to the activity you're doing, and you claim that. Aside from that, if you truly are making a lot of money doing this, you're going to pay some tax. It's just a fact of life. But our firm is the firm I own and founded. We are licensed as portfolio managers with all the securities commissions across the country. So we do manage clients' money, and we do not include cryptocurrency as an asset class in our asset allocation when we design that for clients. It doesn't mean people shouldn't invest in cryptocurrency, or people do anyway. Some people do. I would just be cautious to keep it as a very small percentage of an overall portfolio, probably not more than 3%, maybe 4%, maybe 5% at the most, because it is completely unpredictable in terms of the direction of the valuation. You can't look at any kind of cryptocurrency and evaluate, attribute an underlying value to the currency, because it's not driven by anything tangible like earnings or as you would with a business, for example. So it is risky, obviously, but congratulations if you made money at it. Some people have. I think the best days are gone in terms of making the profits that were made earlier on 10 years ago, obviously, but having a little bit can't hurt, I suppose. Anyway, just some thoughts.
Tim,
Thank
quick
you very
question.
much. Oh,
Tim,
yes,
sorry,
Stan.
just a quick question on taxation of crypto. It seems like it's always been a kind of a gray area. So, if someone is buying a cryptocurrency like a Bitcoin or Ripple or Ethereum, and you sell it and you make a profit, is it taxed as income? Is it taxed as capital gains?
Yeah, it actually depends on, it actually depends. And it sounds like a cop-out to say that, but it actually does depend. So generally speaking, it's taxed like any security would be. So, or any gain on the exchange of currencies. So normally that would be taxable as a capital gain. But if you're undertaking the activity frequently enough and often enough, so you're like day trading cryptocurrencies, CRA could say that's really more akin to a business and it could be taxable as business income. So it depends on the frequency of how often you're trading, how successful you've been at it, and that kind of thing. But as a general rule, for most people, it'll be taxed as capital gains or losses, capital losses.
Okay.
Yeah.
Okay, thank you. One more question, anybody? Okay, great. Well, I'll conclude this webinar, and thank you so much, Tim. Thank you for your presentation, and thank you for sharing your expertise. As I say always, please contact your financial advisor, your financial specialist, and please go to our directory, especially to engage with one of our members. If you'd like to say anything else, Tim, before I go to my last screen here.
No, I just want to thank you, Sonia, for inviting me. I've always enjoyed doing this, and I'm glad to, hopefully I'll get to meet people face to face at some point. But this has been convenient, and it's been great to be with you. So thanks again.
Thanks, Tim.
Thank you. Thank you, Tim. Thanks for sharing your financial expertise. If you have questions or comments, you may wish to contact Tim at our Family Office Inc. info@familyoffice.ca. Tim has been very kind enough to give me a PDF of the presentation today, which we'll be sending out to all the participants today. We remind you to please participate with us. Please, I invite you to be a presenter, a speaker. We're very happy to collaborate with you, and the Chamber is here to help promote and support you in your business endeavors. So do one more. I'd like to thank Spirit Slovenia and URAT, the Office for Slovenians Abroad, for funding the Chamber. We're pleased to present our events on Chin's Glas Kanadski Slovenco. Tune in some Saturdays at 8 o'clock for some Slovenian content for an hour. It's on 100.7 FM. We encourage the support of the VSKO and the Canadian Slovenian Radio by advertising or sharing your announcements, everything, birthdays, all sorts of things like that for our community is heard on there. And I just want to also I'll stop share. Thank you for joining us today. I really appreciate it. We will have other events. In May, we will have another Zoom. It'll be on tourism, not just Slovenian, Canadian, but world tourism, brought to you by one of our members, Ars Longa, which is a Slovenian tour company, but they work worldwide. I happen to have taken a very eye-opening tour of a lifetime with them in November. In June, I'm planning a golf tournament, so I hope to see you in person. Right now, I think the date will be tentative. I'll just tell you. So June 28th, hopefully, and the venue to be announced, but promises to be a nice evening for people. So I'll send the information out for that. Anyway, as a member, we welcome you back. And if you're not a member, please join us. Please check us out on Facebook, LinkedIn, YouTube, and hope to see you again. Hvala lepa and na svidenje.
Bye, everyone.
Thank you.